New records are being shattered left, right, and center in the housing market, and you're probably not hearing about them anywhere else. So, this week, I'm bringing you the leading data that shows more pain ahead all the way around. So, let's get after it. Hey, for those of you that don't know me, I'm Rick Harrison with MVP Realty here in Southwest Florida. And on this channel, I bring you the latest insights and information to help you decide if now is the right time to make your move to paradise. If that thought's crossed your mind, you're in the right place. So, subscribe and tap the bell to stay up to date on the latest information, keeping you ahead of the curve. All right, now let's dive into today's big stories. All right, so by now, I'm sure many of you have heard that the CPI data came out a couple days ago. Things came in a little bit lower than expected. However, what most people don't realize is that the CPI did actually go back up. So that means that inflation is starting to climb again. Not so fast with the CPI celebrations. This comes from Zero Hedge. Rents are surging again and back to record highs. So rent inflation, which is the biggest variable in the CPI's biggest category, shelter, has turned and is now decelerating sharply. At least that's according to the lagging indications that we've all been hearing about on mainstream media. What they should be looking at is the real-time actual rent index, which has been rising for 6 months now and is about to take out all-time highs at a time when the Fed is supposedly pausing its rate hikes and, if anything, is already planning its next easing cycle. For those of you who are unfamiliar with how the CPI tracks rental growth, essentially they do a survey and survey homeowners of what they expect they could get for rent for their property. They don't actually get and use data that is from actual rentals or landlords or property management companies. They actually survey homeowners who probably don't have that great of a pulse on what the actual market is like for rent. Rent inflation had actually topped out late in 2022, which is true, but most of this data is lagging, so it's 5 to 6 months behind, in some cases 12 months behind. And in our next print, we probably will see that rents have gone higher. So that shows us that we are not out of the woods and CPI is far from being tamed completely. So this graph goes to show you typical U.S. asking rent just shy of record high in July, which we just mentioned, and that the year-over-year change is now positive again by 0.3% since a couple months ago. So this next article is also from Zero Hedge. This is about the bond market carnage that's happened over the last couple of days, actually the last couple of weeks, but that has been sending rates soaring towards 23-year highs. So U.S. Treasury yields rose last week despite a relatively tame CPI report. Mortgage rates rose as well. Anybody who's been watching this channel, you know that the 10-year bond market really is the leading indicator for the 30-year fixed mortgage rates. So since the yields have been rising for the 10-year bonds, that is that's basically telling us that mortgage rates are going to continue increasing. The 7.37% rate, which was the highest since October of 2000, nearly 23 years ago. And this is an ominous chart technically. So those of you who follow technicals in trading, and that's what I usually follow for the mortgage rates and the 10-year bond. The U.S. Treasury yield since 1998, technically speaking, this chart is ominous. Rising triangle formations tend to break higher. You can see this first chart up top is a rising triangle as well. That usually breaks to the high side. And I'm going to take you over to TradingView right now to show you mine, which shows more of a flag versus a triangle here. These are what's called bull flags, and the handle here is what the breakout usually is. If this breakout indicates anything, we should be heading out to about the 5% range, which would put interest rates at around 8 to 8.5% at the current risk factors. And right now you can see we are increasing here. We're on a rise, and this is probably going to follow this all the way up. So mortgage rates will probably be heading higher for quite a while longer, at least another couple months. Our third article comes from Redfin. So this is the U.S. housing market. It actually recovered the $3 trillion that it lost in our supposed correction that we just went through. And now we're hitting records at $47 trillion in total value. Luxury homes are losing value, while homes worth between $250,000 and $750,000 are posting gains. And a majority of that concentration is actually between $250,000 and $500,000, which we'll see in the charts below. This chart shows us that we are back to almost near record highs, actually at record highs, $46.8 trillion. The housing market, despite everything that's been slowing down with the buyers and sellers, is still increasing in value, and that has a lot to do with supply and demand. The dominance of the 30-year fixed mortgage rates in America is propping up home values. Tons of homeowners scored an incredible deal during the pandemic, a 3% mortgage rate for the remainder of their 30-year loan. Now they're staying put really, because moving would mean taking on a rate that's twice as high, if not higher. Now that we're over 7%. But right now in America, in the United States, roughly 9 in 10 homeowners with mortgages have a mortgage rate under 6%. Also, home values held up better in suburbs and rural areas than in urban areas. However, that really does vary by area and state. Here in the southwest part of Florida, home values have really kept their values quite well right now. There have been little dips in different areas, but for the majority of the market, it has kept the home values high. Home values between $250,000 and $750,000 saw the biggest jump in value. And as you can take a look at this chart, it breaks down the different colors here. The black one and the gray ones, which are the two highest right now. The gray is leading the way. It's all the way up here at the top. And that is the value buckets between $250,000 and $500,000. So if you have homes within that price range, your total worth of the U.S. market has still been increasing quite steadily, actually. And I think that's going to be one of the biggest areas of increases for quite some time, because most of the people who are sitting on the sidelines right now are going to probably fall in that price range. The people who have over $500,000 to spend on a house are most likely in a better financial position, especially if they're moving down here to Southwest Florida. They're older. They're probably in a better financial position. They might not need to leverage as much money through a mortgage. They might be able to pay cash. And if those three things weren't any indication as to where the market is heading, you may want to consider where Warren Buffett is putting his money. In the second quarter, he bought and sold several of his positions, but the three new buys of his positions were all home builders. D.R. Horton coming in at number one with $726.5 million worth of shares. NVR number two with over $70.6 million purchased. And then Lennar Group, which really wasn't that big of a purchase, but still a new one nonetheless. They did put some money into that one as well. The largest U.S. home builders have been outperforming smaller rivals despite soaring mortgage rates, with stocks rallying and companies welcoming an onrush of buyers frustrated by a severe shortage of existing home listings. All right, now let's head over to our actual Southwest Florida stats updates. Interest rates, as you know, went up to 7.16% according to NerdWallet. Bank rate had it going up to 7.5%. That's up 16 basis points in both cases. Cape Coral to Naples, new listings. That's up 16% this week to 797. Still not getting back to all-time highs where we were seeing over 1,000 new listings on the market. But 16% increase week over week is a pretty good one. And I think that's going to help bring some inventory. I think there's a lot of people selling right now because a lot of people are actually moving out of the area with the rising costs, rising taxes, insurance costs, everything that happened with the hurricane. You'll see a lot of people move out, migrate after that, but a lot of new money is moving in from those bigger cities like New York, Chicago, some places in California, Minnesota, Wisconsin, places like that. Solds are actually down 13%. That is a lagging indicator as to what was going on 30 to 45 days ago. So we did see a dip in the amount of buyer activity. However, we did see an increase in buyer activity last week with pendings at 817. That's down 798. That's just down 3%, but still pretty good considering where mortgage rates are right now. Price decreases, 7% decline in this area of the market. Inventory breakdown. Single families, we gained 21 units, which isn't much. And at the same time, in condos, we lost 42 units. So we had a net loss of 57 last week. We have a net loss of 21 units this week. Multifamilies, we saw a pretty good increase this week in multifamilies in this area. 140 listings on the market. That's up 17. And then foreclosures, we lost 3 from last week. So no changes there. Total sales, 415. Out of that, 188 were cash. Both of those are down, but the percentage of cash buyers is up again from 43%. So it's up just about 2% this week. Here are the month over month and year over year comparisons for this. The biggest, most notable increases and decreases would be in median sale price. Compared to July of 2022, that's actually up 4%. But compared to last month, it's down 6.1%. I shouldn't say last month. Compared to June, that's down 6.1% to a median sales price of $460,000 for Southwest Florida. Closed sales, The big one, obviously, these two are both notable, but the biggest one here would be month over month. So compared to June, that's down almost 20% in closed sales volume. Again, that has a lot to do with the amount of inventory that's been coming on the market, which is also down quite a bit. New listings coming on, so that's down 13%, 2,133 listings. Active inventory is also down 9% month over month. And months of supply is actually up 13%. So believe it or not, 4.6% is getting pretty close to a balanced market. 6% month supply is considered balanced in general. All right, the northern part of Southwest Florida, Punta Gorda to Sarasota, new listings, 701. That's up 19% week over week. That's a huge gain. With the consideration that the amount of pendings that have been going under contract down 6%, seeing a 19% week over week of new listings is not a good indicator for that area. It's suggesting that there's way more new listings coming on than there are buyers willing to buy right now. So that is something we'll have to keep an eye on. Solds also down. That was down 28% week over week from 681 to 487. Again, this is a lagging indicator, so it's just saying that the amount of homes that have closed that were on pending at one point in time is quite a bit down, and that had a lot to do with inventory. Price decreases, that was up 7%. So all these indicators are not showing a great housing market condition up there. It's showing more of a weakening condition, so we'll keep an eye out on that as well. And then latest inventory, we gained 117 single family units week over week, and we also gained another 85 condo units. So we had a net gain of 60 last week. We have a net gain of 202 units this week. That's a big gain, considering most of the gains have been losses or slight gains over the last couple months. Multifamilies, we lost 9 units, same amount that came on, went right off. And then same thing with foreclosures. We lost 7, we had gained 7 last week. So it looks like whichever ones went on the market last week came off the market this week. Total sales, 410, cash sales, 203. That's actually up percentage-wise. That was down at 43%, or almost back up to 50% cash sales in this area. So we can see who's moving into the area and buying. For this area, the July statistics, month over month and year over year, pretty much all of these are relevant because there were some big gains and some real, some big gains in the area, but also some significant statistics to keep an eye on. For instance, new listings, 7% month over month down, and then 23% year over year. So those are huge decreases in the amount of new listings coming on the market. Pending sales was also down, but it's down half as much. So you can see that there's still quite a bit of demand. There's more demand right now than there are sellers willing to sell. Pendings down 3% and down 1% year over year. Listings sold 14%. So these are actual sold that have closed out. That's down 14% over last month in June, and then down 5% year over year. Active days on market, we actually saw the days decrease a little bit in this area, but it's up 156% year over year. So that's a big one as well. Average sale price down 3% like those were showing before. And then months of inventory, just it's actually about the same. So July of 2022 was at 3, and last month was at 2. So we actually did gain a little bit there. As always, we've got a lot to keep an eye on, and that's exactly what I do on this channel every week. So don't forget to subscribe. And if you have questions, please don't hesitate to reach out to me directly, as many of you do. My contact info is in the description. Thanks again for watching. I hope to see you on the next video, but until then, stay safe, stay positive, and more importantly, stay free.